guys. Okay, what I'm going to do moving forward is I'm going to limit my videos to shorter time frames so that I don't have to spend all day rendering them. What I just did is I made a huge, like, hour-long video answering a single question, which is not a good use of my time, and it's going to take too long to actually render it and upload it to YouTube. So I'm going to limit myself to short answers. They might not be as in-depth as you like them, but I have other things that go in-depth that you can use if you want to learn more. Alright, so I'm talking about courses and services, so you can just Google me. You can hire me for phone coaching as well if you want. Alright, so here's what's going on. Mirza, is a girl's name, asks in response to a video I made on how to read stocks, which presumably contains an area gap. Mirza asks, what do you do if the gap is not small like you see for FedEx on June 22nd? She's saying that FedEx is not does not contain a small gap like the gap that I showed you in this video. So the gap I showed you in this video was small. It's on BBG. Now, what is small? Well, first of all, you short this because a small quote-unquote gap is actually what's known as an area gap, and an area gap almost always fills. Alright, so Mirza is saying, what if the gap isn't small? Now, to answer that, we need to know what exactly the meaning of small is. Let's take a look at the FDX. We're going to look at that gap that she referred to, which is right here. Now, is this small? Is it not small? How do you know? My rule of thumb for whether a gap is small is to go back to the 30-day candlestick chart and see if the gap is inside, see if the new candlestick after the gap is inside or outside of the previous 30-day trading region. Now you can see that FedEx from 30 days ago was trading in a rather tight region of 156 to 167, but after that gap, what we got is a brand new uncharted area that we have moved into. By that definition, I would say actually that is a very strong definition and probably useful. I always ask myself, is this indicator or is this definition capable of being encoded in an algorithm? So if you can't write it down in code, it's not a good indicator. You can't write down small or large in code, so that's not a good indicator. But you can write down whether it's made movements outside of the 30-day trading region. And in that case, I'm going to call this a wide or large gap. Now the question she asks is, what do you do after a gap like this? Now, I made a checklist here, and I want to talk about the type of gap it is, which is an earnings gap. What is an earnings gap? I'm not even sure if that's it's a term. I'm going to take a look. I think it is, but let's just assume it's not. I get to define it anyway, because like if you type in gap trading, I'm pretty much the guy who comes up. So I think I have a lot of leeway in defining new terms. Okay, earnings gap is talking about the gender gap, which is unrelated to trading. So we're going to call this an earnings gap. Now, what's an earnings gap? An earnings gap is a gap that occurs the day after an earnings report is released. Now, what I'm doing these days is I have extended my Gap Gameplan strategy into an earnings-based strategy where I trade both before and after an earnings report. The earnings report is important because you get new information about the stock. That information comes in two flavors. It comes in what happened in the last quarter with this company that we didn't know about, and what is company management expecting for the upcoming quarter. Both of these are important in determining what's going to happen to the stock after the gap, fundamentally. Now, technically, we don't care that much, but we kind of do care. Anyway, what happens here is when FedEx beats, or when a stock beats on, by the way, Seeking Alpha is probably the best place to go to for earnings info. All you have to do is type in the ticker and then click on earnings like you saw, and you'll see a article like this. You don't need to click on the article, but you'll see them in this form. Company beats or misses by, and then beats or misses on revenue. The first one is EPS, the second one is, well, revenue. And EPS is generally more important. If you see the word beats, that's bullish for the stock, and if you see the word misses, it's bearish for the stock, and it simply means that the company reported earnings that are different from what Wall Street analysts estimated. Now, if that occurs, the stock jumps in price. But we didn't see that occur on June 22nd for FedEx. Instead, the stock fell. Why did it fall if it beat on earnings and beat on revenue? Well, sometimes that happens. And it happens because the company issues what's called weak guidance. In other words, the company will say, yes, the past quarter was good, but the next quarter is probably not going to be so good. That's what I was just talking about in a earnings report. Information release. We've got two sections. We've got the future and the past. We've got the hidden information of the past and the hidden information of the future. And in the American Stock Exchange, that hidden information of the future can override the hidden information of the past. Now, if that bothers you, you can trade on the Chinese Stock Exchange, where they don't really care about guidance, they care about the EPS, and it's probably a lot easier to play because EPS predictions are easier than guidance predictions. Now, that's not to say you can't make a guidance prediction, and I just made one in my trades service. If you go to damonberry.com, you can just go there. Go to damonberry.com and sign up for the Copy My Trade service. You'll receive an email from me every day on a trade I'm going to make. Usually, not always, but usually they're gap related. So I'm either predicting a gap or trading after a gap. Now, the one I sent out yesterday, and it's a little too late to play this now, but the one I sent out yesterday was on Nike, which just reported, and it's the same situation for Nike as we just saw for FedEx. It beat on earnings, it beat on EPS, but the stock fell because of poor guidance. Now, what I told my subscribers to do is expect a beat on EPS, but also expect guidance to drag the stock down. The reason is, well, I correctly predicted poor guidance, but the reason is, I'm not saying the reason the stock goes down, the reason that guidance is more important than EPS is simply because its effect size is larger. The statistical backtests that you run on this data set shows that movements from guidance are stronger than movements from EPS. So there was probably some upward movement in Nike being priced in, but the guidance was also priced in. So adding those upward and downward movements together, you get a downward movement simply because guidance is stronger than EPS. It has a stronger effect size. So when you predict what's going to happen for earnings, you also have to take into consideration guidance. Now, luckily we did this, and I said, look, we're going to beat on EPS, but guidance is going to drag down Nike, so we should take a short strategy, either open a short synthetic or buy a long put, and it turned out we were right, luckily. Now, we can't play the gap yet, and the reason I'm telling you this is because there's going to be a gap appearing, and you're going to probably want to watch Nike and use the info from this video to trade Nike. But the reason we can't trade Nike now is because we really do need the gap. What happened here? What's going on? We really do need... Where'd that gap go? Okay, we lost something here. But we really do need to see the entire gap. We're missing a candlestick. Okay, I don't know what went on. But we do need to see the gap before we can trade it. So we know that Nike's going to have a gap, but that is not Nike. What is this? Oh, Nike had 2 gaps in a row. Yeah, that's right. But we need to see the gap. And the reason is we use a number of indicators to predict the movement after the gap. So I'm now answering directly Mirza's question. What do you do after a gap? Well, you use indicators after that gap to determine what's going to happen. There's a lot of, I would say, rules of thumb for trading just based on drift and market expectations for a company after an earnings report. But like earnings and guidance, they can be contradictory, and one can actually prevail in the end. So I'll leave you with these 2 concepts. Well, I'll start you with these 2 concepts, and we'll get into the technicals of what happens to a stock after an earnings report. Now, one concept is the concept that not all of the information released on the day of earnings is immediately priced into the stock. It takes several days for the new information to be internalized by both traders and by the stock itself. So the implication here is that if the earnings report drags down the stock, you want to bet in that same direction. You want to bet that the stock will fall further because not all of that bad news is priced in. That's idea number 1. Now, concept number 2 is that of the mean reversion. So the idea is simply, when you see a gap like this, it's a overreaction and the stock is going to bounce back. It's an overreaction both statistically because now you've left the average, you've diverted from the mean, and it's an overreaction in investors because there's panic selling or panic buying in the bullish case. What's a gap that I traded recently that went upward? What was it? I think Smith and Wesson. Yeah, okay. So the idea is, those 2 ideas I just mentioned are contradictory, right? One is that not all of the earnings is priced in on the day of the gap, and the other is that the gap is an overreaction. So which one prevails? Well, it turns out that neither are right by themselves. There are multiple factors that need to be taken into account before you can determine the direction of a stock after an earnings gap. Now, there's so many factors that I'm trying to build a statistical model that incorporates it all, so I don't have to do all the labor of looking all of this stuff up every time I want to make a trade. But you don't have the advantage unless you're a quant or a programmer. You don't have that advantage, so I'm going to tell you how to do it based on info. All right, so based on the info that you get, how can you quickly predict the movement after an earnings gap? Well, first there's the candlesticks after the gap, and that's why I recommend you wait after a gap before you make your trade. And this is something I talk about in the Gap Gameplan. I say wait 2 to 5 days, and then eventually you're going to see one of those candlestick patterns. Here we are. So in the Gap Gameplan course, when you downloaded it, you got step 3, which has 2 folders, and in those folders I show you what happens after a gap and the candlestick patterns you should be watching out for. Now, if you wait 2 to 5 days, you're going to see whether these occur or not. The shortest one is a 2-day pattern, right? And the longest one is going to be we just saw a 5-day pattern. A 5-day pattern. That's why I say wait 2 to 5 days. Now, there's a problem with this, and that problem is sometimes while waiting the gap already fills or the gap becomes wider, and the idea is simply that you feel regretful that you missed a significant post-gap movement. Now, I'm trying to deal with that, and I've had to deal with that myself. It's just something you naturally have to deal with by creating a new trading strategy that trades after one candlestick. And I'm going to be releasing that trade strategy soon in the Gap Game Plan 2. I've actually completed the course. I just need to render the videos and put up the sales letter and stuff. But it's out there. And what happens is we look at the gaps. We look at three aspects for these candlesticks. I've actually created a set of 18 strategies to use based on the two candlesticks that you see around the gap. So there's the candlestick before the gap and the candlestick after the gap, and all we care about is the type of candlestick. Is it a red candlestick? Is it a black candlestick? Or is it a doji star? Those are the three candlestick types. So you look at the candlestick type, you look at the gap direction, and then you look at the second candlestick type, and those the three things together should give you a pretty good idea as to which way the stock is going to move. Now I'm going to teach you those in the Gap Game Plan 2.0 course, but let's just look at an example for the meantime. And we're looking at FedEx here, which is what Mirza requested. And the gap we're looking at has a green candlestick, then a down gap, and then a red candlestick. So in this new course, after you download it, what you'd be doing is you'd go into the Gap Game Plan 2.0, you'd go to the rules, you'd click on down gaps because that's the kind of gap you got, and the first candlestick was white, and then you'd watch the video where the first candlestick was white and the second candlestick is black, and that'll teach you. Well, time's up. I'm going to keep going. I'm going to just rush through it. So that's going to teach you which direction to play. Now for white down red, the direction is downward. You want to be bearish after this, and you would have been right on the next day, and you probably could have gotten out on the next day, but it depends on how long you want to stay in. But yeah, you're going to be wanting to look at the colors of the candlestick and the direction of the gap. That's indicator 1. Let's try to rush through this. Indicator 2 is drift. A stock that's moving upward or downward and then gets a gap in the same direction, for example, a stock that's already moving downward and then gets a down gap, tends to continue in that direction. Now FedEx doesn't have any clear drift before that gap, but let's say it was trending downward before we saw that gap. Well, that leads us to believe that it's also going to continue trending downward. Now the opposite here is if it's going upward and we see an up gap, generally the stock is going to continue trending upward after that up gap. Indicator 3, price to earnings ratio. What you need to do is you need to look at the price to earnings ratio of the company and compare it to the industry. The best place to do this is Morningstar. So morningstar.com, just type in Morningstar and then your ticker. Click on the link. Wait, because Morningstar is a super slow site. And by the way, I'm showing you 5 indicators that should be used together. If you have, for example, 4 of them saying bullish and 1 bearish, even though that one is bearish, you're probably going to want to ignore it and just go with all the other indicators together, because the more bullish indicators you have, and by the way, these are all statistically relevant, so I'm not just pulling stuff out of my ass and saying, hey, this matters. These have all been back tested. So if you have like 4 back tested indicators that are saying the stock is going to move upward, you're probably going to want to bet in that direction. All right, so use more than one in conjunction with the rest, and kind of consider them as different brains or different people giving you advice. So you've got 5 advisors here, and you want to take all of their advice into consideration. In the Gap Game Plan, I talked about the 3 brain system, where we used a very similar system, but with 3 indicators. Now we have 5. All right, but you don't have to use all of them. If there are some you don't like, fine, don't use them. But I mean, a lot of these are easy to check. Honestly, size and volume, I don't really check that often because they aren't really that relevant. There's not a huge correlation between the size of the gap, the volume on the day of the gap, and the direction of the gap. But I'm going to show you them anyway. All right. So price to earnings, what you do is you go into Morningstar, type in your ticker, and then you scroll down to price to earnings, and all you have to do is look at whether it's red or green. Red is a bad, green is good. All right. Red means the stock is overpriced relative to the industry. The other stocks in the industry have lower price to earnings ratios, and green is vice versa. Now this is relevant because studies have shown that a stock with a really high price to earnings ratio relative to the industry, and everything I say works on when you flip it around, right? It works for vice versa. I'm not going to talk about the vice versa case because I'm short on time. So we're just going to talk about this one case of FedEx where we find that the price to earnings ratio is grossly overpriced. When this occurs, when you see a stock with a really big price to earnings ratio, the down gaps will have more power than the up gaps. In other words, the stock, because of its overpricing, because it's essentially a glamour stock that lots of investors want to hold on to because of the name value of the company, the stock has a lot of expectations, and if it does not perform as per those expectations, the stock is greatly punished, and that punishment will last after earnings. So in the case of FedEx, we already have the candlestick indicator showing a bearish tint, and then we have the glamour stock aspect that gives us a bearish tint. The price to earnings ratio is too high, so that puts us bearish after the gap. The drift is inconclusive, we're sideways, right? So now we just have to look at two more aspects, which are the size of the gap and the volume of the gap. Now the size of the gap I spoke of at the beginning of this video. If it's in a new trading region, then you want to consider that a breakout gap or breakaway gap, which means that it's going to continue moving in that direction. So here we have that as a bearish indicator. And then finally the volume. If the volume is very large, it tends to be an indication of a breakaway gap. Now, we're looking at gap day. Now this was a very significant volume increase, and that's a selling, it's a day of panic selling. Generally a day of panic selling is followed by another day of panic selling, and that drags the stock price down. So we've got four bearish indicators here telling us that after this gap, immediately after that gap, on this day at the price of 149, we should have shorted the stock and rode that trend downward. Now the remaining question, I'll leave you with this thought because we're out of time. The remaining question is, how long does that stock get punished for the earnings? In other words, for how long should we hold a post-gap position? This is an issue that I'm currently resolving through genetic algorithms, genetic programming, but I have to deal with things like overfitting. So I have not solved this yet, but a safe swing trade is just to hold for a week. Just do it for 5 days and then get out. And that's the time frame I use for pretty much all of my post-gap trades. And I've actually written an algorithm to show the results per ticker. So actually I could show you those for FedEx. And I always throw my post-gap trades into my Lucky Chloe algorithm before I make the trade, so that I have more evidence that the strategy works. So here's the FedEx trade, and we'll see if it's profitable to short the stock after a gap. Now this is a back test. It doesn't look at the most recent gap, it just looks at all the previous down gaps with that particular candlestick pattern, the white down red over the last year, and then it shows the results. So we're going to look at that for FedEx, and this is more of a confirmation for me. It can be treated as a buy or sell signal as well, but I just use this to confirm whether what I'm looking at is correct. So here's what we see as the performance of this strategy, and this is the annual returns. So if you were to wait for white down black candlesticks on FedEx and then to short the stock when that occurs, you would be right 61% of the time, just looking at the candlesticks, not looking at the other indicators. And the odds are in your favor in terms of drawdown versus performance, just for shorting the stock. Now remember, I like to trade options, so I actually have a non-linear payoff. I get a lot more when I'm right than stock traders do. But let's say you're trading stock and you're just using this strategy. This number is the annual payoff for that strategy. So you can expect 45% ROI on this strategy, and it looks like all of these come during a time of earnings, and it looks like you would have made, by the way, the holding day is 5 days, the holding period is 5 days, and you would have made like 10% ROI every time you did this. So the conclusion of this example is that FedEx looked like a short on this day after earnings, and it might not be too late to get in on this position. It looked like a short, and the reason was we have those 5 indicators that you should look at every time you see a post-earnings gap and determine what are they like. Are they bullish, bearish, or inconclusive? For FedEx, we saw bearish, inconclusive, bearish, 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 and that should be enough to tell us we should probably take a short position if we're going to take a position at all. That is it. I have gone over time. If you felt that this video was helpful, please leave me a like and subscribe to this channel. And also realize this video came from a request. Someone requested the video and I made it. So please do the same in the comment section below. If you have any questions or want to look at a specific strategy or have any questions regarding gaps or comments, whatever, leave it down below. I'll make the video for you. This is how I start my mornings. So that's it. Happy trading.